What's happening, options traders? Happy Tuesday, everyone. And after the 4-for-1 Apple split yesterday, I've had a number of traders asking about a strategy called a dividend play. Apple's been known for paying a fairly high dividend, and so after the split, these traders are thinking, well, now that the stock is cheaper, maybe it's going to be a really good strategy. So what is a dividend play? Well, it's actually a very interesting, probably one of the more interesting strategies in all of options. And it's a strategy that is done just before the X date for the dividend. And what the trader's doing is hoping to collect a dividend because the long call failed to exercise. So it's a strategy that actually falls into what's called a risk arb. It's not a true arbitrage. There's a little bit of a risk to it in the fact that you might not succeed. So the philosophy here is that you might win, but you really can't lose. Now, even that's not 100% true. There is some downside risk. It's just that it's very slight. But this is really what the traders are thinking is going to happen. Might make some cash, but not really a lot of risk. And there are two ways that we can carry out the dividend play. One is with a covered call, and another is with vertical spreads. So here's how it would work with a covered call. Let's say that you buy shares of stock, and then you will sell a deep in the money call. Could be trading at parity. If not, it's going to be very close. Remember that parity means it's all intrinsic value and no extrinsic. So it doesn't have to be right at parity, but it's going to be very close. So for instance, let's say that our stock is trading for 100 and it pays a $1 dividend. And in fact, it's going X dividend tomorrow, which means the stock's price is going to be reduced to $99 tomorrow. That's just saying the $100 stock price minus the dollar dividend. And again, the reason that the exchanges do this, reducing the stock's price, is because the company just paid out $1 worth of its assets per share. If it was worth $100 yesterday and it just paid out a dollar dividend, then it can't possibly be worth $100. So the exchanges reduce the stock's price by the amount of the dividend on the X dividend date. Now, also interestingly, little side note, is that the exchanges will show that as $99 unchanged. And sometimes traders get confused with that and they'll say, well, wait a minute, the stock was 100 yesterday and it's 99 today. Why isn't it down $1? And the reason is it's not due to supply and demand. It's not because of negative news. It's just because the stock paid a dividend. But regardless of the reasons why, it's these actions right here that set up the strategy, the payment of the dividend and the stock's price being reduced. So here's how it's going to work out. Let's say that you buy 100 shares of stock and then you're going to spend $100. Next, let's assume that we sell the $80 call trading for 20. So in this example, the $80 call is trading at exactly parity. And that's because we can add the $80 strike to the $20 premium and we do get exactly the stock's price. So when an option is trading at parity, there's no difference between it and the stock. It is stock. And so these should absolutely be exercised, but they're not always done. And that's what we're setting up right here. So at this point, what's our cost? Is $80. We spent 100, we collected 20, so we're in for $80 right now. So once we've entered this position, keep in mind this is the day before the X date. One of two things are going to happen. We'll either get assigned or we won't get assigned. Now theoretically we should, but what we're hoping for is that we don't. So let's start with that case first. Let's say that we don't get assigned. What's going to happen now? Well, as we just talked about, the stock's price is going to drop to 99 and your call's price is going to drop to 19. And that's because up here it had 20 points of intrinsic value, the difference between the strike and the stock. Well, now the stock's at 99. So this $20 call is going to fall to $19 on the opening bell. And so this is actually another reason of understanding why it should be exercised. You've got delta 1 up here. You've got the calls. So somebody who buys the calls is delta 1 before and after. You might as well grab the dividend. So what's the value of our position here if we don't get assigned? Well, the broker's platform is going to show that our stock position is worth 99 and our call option is worth 19. This is an amount that we owe. It's a short call. So 99 minus 19, our total value is 80, exactly what it cost us. So we haven't really taken a loss of any kind. even though the stock's price was reduced and our options price was reduced. And the reason that we wrote this call so deep in the money is for this very reason. It's just not going to affect us. However, we did collect the dollar dividend. So if we did this 500 times or 500 shares, we just picked up $500 and really didn't have any downside risk. Now notice that I said really didn't have any, which is not the same as saying that we have none. The risk is that the stock price falls below this $80 strike, in which case we will start heading into losses. But remember, this is probably, might only have a week to go. And being this far in the money, it's a really low chance. But just wanted to point out there is still a risk. So this is what we're hoping for, is that we don't get assigned. But what happens if we do get assigned? Well, as before, the stock price drops to 99 and our call price drops to 19. So at this point, no difference from when we were not assigned over here. However, if we get assigned, we are going to receive $80 per share. That's the deal. The person who bought this call, if they exercise, has to pay the strike. So we just collected $80 cash per share, and it cost us $80 to put this on, so we didn't earn anything. So as I mentioned before, the philosophy of the strategy is we're hoping to collect this dollar dividend, but if we don't, probably just going to earn nothing. Okay, so how would you carry out the strategy with vertical spreads? Well, it's really the same idea. Let's say that our stock is at 100 and you buy a really deep in the money vertical spread. So perhaps buying the 75-80 vertical that is trading for 5. Under normal circumstances, it wouldn't make a bit of sense to pay 5 for the spread because that's the most that it can be worth. But for the dividend play, it can make sense. So the idea is here that we're just so deep in the money. Remember, the $80 call was trading at parity, and therefore the 75 must absolutely be trading at parity. So the vertical spread would be trading for the difference in strikes. And what we're going to do is we're going to buy this spread for a $5 debit. However, once we do that, we will immediately exercise the 75 call. That's the call that we bought. When you buy a vertical spread with calls, you are buying the lower strike. So we're going to turn around and exercise that 75 call, but we're also short the 80 call, so we have the potential obligation to sell for 80. And because we're so deep in the money, that's probably going to happen. And if it does, it's a $5 credit we end up with. We paid a $5 debit, we get a $5 credit, no harm done. But if we're not assigned, we collect the dollar dividend. That's what we're hoping for. Now also interestingly, you could make this work by selling the vertical because we're so deep in the money. We could sell the 75-80 vertical and get a $5 credit. And when we're exercising, we're going to exercise the 80 call. That's the one that we're long. So we would exercise the 80. We would be long shares of stock, and we have the obligation to sell for 75. That's the short strike right here. And if we do that, that's a $5 loss, right? You pay 80 for the shares, you sell for 75. So we might take a $5 loss, but we received a $5 credit. So again, no harm done. But we might collect the dollar dividend. So that's really the essence of the dividend play. You're just taking shares of stock, writing an option so deep in the money that mathematically it should be exercised, and you're just hoping that the long position makes a mistake and doesn't exercise. The problem with the strategy, for at least a lot of traders, is that it's capital intensive. Most of the dividends are quite small, so to really put some money in your pocket, you might have to do this 500 or 1,000 times. And even then, you're not guaranteed to collect that money. So it's usually best for the larger wire firms, the market making centers, but it's still an interesting strategy to understand. And if nothing else, it shows you the versatility of options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab, as well as many tutorials on courses like the Greeks and volatility. And also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.